What if I told you that the most advanced AI-driven tech company of the next decade might not be some trillion-dollar Silicon Valley startup?
I mean, I'd probably say you're crazy. We're so conditioned to think of innovation happening in, these sleek glass campuses,
Right.
not exactly on a factory floor surrounded by 1,000-degree furnaces.
Yeah, but that is exactly what we are getting into today. Welcome to today's deep dive. We've got a really fascinating stack of sources to go through.
We do.
We're looking at the Q3 2026 earnings report and the March 2026 investor presentation for Worthington Steel. They trade on the New York Stock Exchange under the ticker WS.
And the mission for this deep dive is, well, we're examining exactly how a 70-year-old, $2.1 billion traditional metals processing company is handling the absolute chaos of our modern economy.
Which is wild to think about, because if you are listening to this and you're tracking the shift in electric vehicles or, trying to understand how global supply chains are functioning right now.
Or just fascinated by how legacy companies adapt to AI.
Yeah, exactly. Worthington Steel is the perfect bellwether for the broader physical economy.
They really are. Because the companies that pour the foundation and provide the raw materials, they feel the market shifts before anyone else does.
Yeah, so just to set the stage for you, Worthington was founded way back in 1955.
A completely different era.
Right, and they operate 37 locations now with about 6,000 employees. But they are currently going through this massive multi-front evolution.
They're balancing a major acquisition with, honestly, wildly fluctuating raw material costs and a completely shifting automotive landscape.
So to understand where they're going, we first need to look at exactly where they are right now.
And on paper, this quarter's numbers looked quite bumpy.
Bumpy is a good word for it. Let's just lay out the raw numbers from the sources. So actual earnings per share came in at 27 cents.
Which missed expectations by a full 20 cents.
Yeah, a big miss. And revenue was $769.8 million, which missed projections by over $113 million. Right. And on top of that, their toll processing volumes dropped by 22%.
Which, just for context, toll processing is when they process steel that is already owned by their customers.
So yeah, an algorithm scraping those headlines would definitely flag this company as hitting a wall.
Oh, absolutely. But there is a major caveat buried in the financials.
Okay, let's unpack this.
Well, this specific quarter absorbed $15.4 million in pre-tax SG&A expenses.
Selling, general, and administrative.
Exactly. And these were costs tied directly to a massive upcoming acquisition of a German company called Kloeckner.
Okay, let's unpack this because context is everything here. SG&A in an acquisition of this size isn't just some minor line item.
No, not at all.
We're talking heavy legal fees, international consulting, regulatory filings. I mean, think of it like buying a new house.
Oh, that's a good way to look at it.
Right, because the closing costs make your bank account look absolutely terrible for a month.
Yeah, you feel totally broke.
Exactly. The fees drain your cash flow, but it's a one-time transactional hit. It's not an operational leak. At the end of the day, you still get the house.
And that distinction is crucial. Management was very adamant that these Kloeckner expenses are just timing related.
Right.
They obscure the actual ongoing performance of the underlying business.
But let me push back on that underlying performance for a second.
Sure.
Because even if we completely ignore that $15 million in closing costs, we still have to answer for that 22% drop in toll processing.
That's fair.
And they're facing hot-rolled coil prices that are just incredibly volatile. Prices just jumped $175 to hit $975 per ton.
A huge spike.
So my question is, at what point do we stop calling this a cyclical bump and start asking if something is structurally broken in their end markets?
Well, what's fascinating here is how the underlying cash flow tells a completely different story than that top-line miss.
Okay, how so?
Well, management views that toll processing drop as strictly cyclical, not structural. A big chunk of that drop was actually planned consolidation. They strategically closed a facility in Cleveland last year.
Oh, okay. That makes sense.
Yeah, and the rest is just standard near-term demand fluctuation.
Right.
But to answer your question about structural integrity, you have to synthesize the cash data.
Right. Follow the money.
Exactly. Despite the revenue miss and the drag from the acquisition, Worthington generated $63 million in operating cash flow this quarter.
Wow.
And $33 million in free cash flow. So it proves our core operations remain super resilient, even when the headlines look bad.
That is a serious cushion. I mean, generating that kind of free cash flow when steel is pushing $1,000 a ton,
Hmm.
it implies their internal controls are really tight.
Very tight.
But to really understand the fuel for their core engine, we have to talk about the automotive sector.
Oh, absolutely. It's huge for them.
Yeah, a massive 55% of Worthington's sales come from automotive.
Over half the business.
So if you want to understand their performance, you have to look at what's happening with the Detroit 3 automakers.
And the production data there shows a really wild divergence. Overall production for the Detroit 3 only grew by 3%.
Which is basically flatlining.
Basically, yeah.
Mm-hmm.
But Worthington's direct shipments to those exact same automakers increased by 13%.
Wait, really?
Yeah, 13%. They are completely outpacing the broader market.
So they are structurally taking massive market share from somebody else.
Exactly. They're winning new programs and leaning on these really long-standing relationships. But, and this is a big but, the auto industry is in the middle of a tug of war right now over electrification.
Right, BEVs versus hybrids.
Yes, and that macro confusion is bleeding right into Worthington's timelines. They are investing heavily in new electrical steel capacity in Canada and Mexico.
And this is the super specialized steel needed for EV traction motors, right?
Spot on. But those investments are facing delays. The OEMs, the automakers, are actively pushing their pure battery electric vehicle platforms further out into the future.
Because the demand isn't there.
Right. So because of that, Worthington's new facilities won't actually hit 75% capacity until fiscal 2029.
Fiscal 2029, that's years away.
It is. The market is just pivoting hard. U.S. hybrid sales increased 18% in 2025.
Consumers are voting with their wallets.
Exactly. They're shifting away from government-mandated BEVs and moving back toward hybrids.
Well, here's where it gets really interesting. Because you look at that delay to 2029 and think it's a disaster, but Worthington is actually perfectly hedged.
Yes, they are.
They provide the electrical steel laminations for the hybrid's traction motor, and they provide the specialty cold-rolled steel for the internal combustion engine powertrain.
They play both sides of the fence.
Yeah, they don't care what kind of car you buy, they've got the steel for it. But let me ask you this. If that full production ramp-up is delayed to 2029, does this dead space hurt their immediate growth?
It's a valid concern.
Or does their ability to play both sides of that hybrid and EV divide give them like an impenetrable moat?
If we connect this to the bigger picture, this shift perfectly highlights the friction between top-down government policy and actual consumer behavior.
Like the elimination of the fuel economy mandate.
Exactly.
Yeah.
And the rolling back of the $7,500 tax credit. Without those artificial floors, consumers are opting for hybrids because of, rising oil prices and geopolitical supply chain fear.
They just want something reliable.
Right. So to your question about the delay hurting them, yes, management acknowledged the short-term return on capital risk. But Worthington's adaptability is exactly why these long-standing customer relationships are crucial during industry transitions.
They act like a shock absorber for the automakers.
Precisely. They absorb the uncertainty.
Okay, so while they are busy navigating these shifting automotive sands in North America, they are simultaneously executing this massive gamble across the Atlantic.
The Kloeckner acquisition.
Yeah, the largest acquisition in their history. So they launched a voluntary tender offer for Kloeckner in Germany, and they expect to easily meet this 57.5% minimum threshold. And the sources show they actually used $101 million from an ABL and asset-based lending facility to go ahead and purchase 8% of Kloeckner's shares on the open market.
Which means they are using their own physical inventory and receivables as collateral to fund this.
Right, but the European market right now is a massive headwind. Worthington's existing European operations, Sedum, actually saw their EBIT drop by $8.4 million.
Yeah, a tough quarter for them over there.
They are dealing with really weak demand and super intense competition from China.
This raises an important question, though. Why is Worthington doubling down on Europe right now?
Especially when the European economy is struggling and the German stock market is down 8% year to date.
It seems crazy, right? But it's actually a classic countercyclical value-enhancing acquisition strategy. You don't buy distribution networks when the market is peaking. You buy them when they're distressed.
Oh, it's like buying blue chip stocks during a market dip.
Exactly that.
It hurts your portfolio in the short term, but you're building a massive footprint for the eventual rebound.
You're buying valuable assets at a severe discount.
But let me play devil's advocate here. With energy prices fluctuating so wildly because of geopolitical tensions, like the conflict involving Iran and Europe being so heavily reliant on energy imports.
Yeah, the macro risk is real.
Right. Is management taking on way too much debt and geographic risk right now?
It's the big elephant in the room. But management's stance is that they are entering us with their eyes wide open. They believe that Kloeckner's existing free cash flow, combined with the new efficiencies Worthington will bring, will allow them to service that debt rapidly.
Okay, so they are betting they can fix the house while they wait for the neighborhood to improve.
That's a great way to put it.
Which perfectly transitions us to the final part of our deep dive today. Because when macroeconomic forces, like a European recession or EV timeline shifts, or steel prices spiking to $975 a ton, when all of that is completely out of your control.
You have to focus strictly on what you can control.
Exactly, the inside-the-house transformation. And for Worthington, that means the Worthington Business System and the application of artificial intelligence.
Which is so fascinating for a heavy metal manufacturer.
It really is. Like, let's look at their facility in Delta, Ohio. They completely replaced their forecast-driven push process with a demand-driven pull process.
And just to clarify for everyone, a push system is when you run machines at full capacity based on a quarterly forecast and just hope the market buys it.
Right, which guarantees you'll build inventory of the wrong thing in a volatile market.
Exactly. But a pull system means production is dictated strictly by actual downstream demand.
And the results from doing this at Delta are just staggering. They reduced their held coils by 60%.
Wow.
And they cut their overall inventory by 6 full days over the course of 26 months.
That is millions in working capital freed up.
Yeah. And they aren't just doing this on the factory floor. They are racking up these administrative AI wins, too.
Oh, the back office stuff is incredible.
Right. They deployed an AI agent for daily cash posting that saves their analysts 30 hours a month. And they brought in automation for accounts payable that removes 150 hours of manual work per month.
Just reading unstructured data and clearing ledgers in seconds.
So what does this all mean? Think about it like taking a classic 1955 muscle car and installing a state-of-the-art computerized engine management system.
I like that.
It's the same reliable exterior, but it's vastly more efficient under the hood.
It has a central nervous system now.
But I have to ask, does shaving off 180 hours a month in administrative tasks really move the needle for a $2.1 billion company? Or is this just management using trendy AI buzzwords to keep the investors happy?
I get the skepticism, I really do. But these aren't just isolated tech party tricks.
Okay.
Management is building a repeatable capability. By laying this predictive AI over their lean manufacturing principles, they can spot problems faster.
So it's about the compounding effect.
Exactly. They operate with significantly less working capital, which directly insulates them against those volatile $975 per ton steel prices. It's structural defense.
That makes a lot of sense. It's not AI for the sake of AI. It's AI for survival.
Precisely.
Well, this has been an incredible journey today. Just to recap, we started by looking past a pretty messy top-line earnings miss.
Right. The headline numbers didn't tell the whole story.
No, because beneath that, we uncovered a massive counter-cyclical European acquisition with Kloeckner.
And a really strategic pivot to capitalize on the hybrid vehicle boom.
Yeah, that perfect automotive hedge. And finally, we saw this stealthy, highly effective AI integration happening right on the factory floor.
Which is why tracking a company like Worthington Steel is so important.
Exactly. It provides a real-time pulse on the global economy. If you want to know if supply chains are genuinely tightening or if the auto industry is really walking back from pure EVs, you watch the companies that supply the raw materials.
They're the leading indicators.
They really are. And that leaves us with a final, somewhat provocative thought for you to ponder.
Oh, got it.
As we watch a 1950s steel manufacturer successfully deploy AI to predict cash flows and lean out inventory, what does that actually mean for the future of legacy industries?
That is a big question.
Right. Like, will the defining companies of the next decade really be these sleek tech startups? Or will they actually be old-school heavy metal manufacturers who have quietly learned how to outcompete the competition?
It completely flips the script on who owns the future of tech.
It really does. Well, thank you so much for joining us on this deep dive today. We'll be right here waiting to explore the next stack of sources with you soon.